China is definitely making a move to make gold exchangeable for yuan by opening vaults. I can see that central bank demand for gold is probably going to accelerate. And the other side of it is that following the debacle earlier this year, when the Bank of England had a rush on its vaulted stocks, I think the central banks who saw their leased gold walking out of the door will think, I don't think we really want to do this in future. So I think you'll find that gold leases, which are essential for the liquidity of the forward market in London.
Alasdair Macleod outlines a major structural shift unfolding across the global gold market, one driven not by speculation but by strategic monetary realignment. China's move to expand vaulting capacity and make gold directly exchangeable for yuan signals a deliberate push toward a parallel settlement system outside the Western framework. This alone is a powerful incentive for central banks to increase their reserve diversification, but the aftermath of this year's Bank of England scramble has dramatically amplified the trend. As leased gold suddenly disappeared into private hands, many central banks realized they were exposed, and Macleod suggests that the willingness to lease bullion, a cornerstone of London's forward market liquidity, may begin to evaporate. Less leasing means tighter physical supply, weaker paper influence, and a forward market that becomes increasingly fragile. In that environment, central bank gold demand doesn't just persist, it accelerates. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
Gold and silver, last time this happened, we were looking at the great financial crisis, 2008, 2009. Gold was sold down from $1,000 down to about $680. So it then went on after that to go up to $1,920, which was a significant move, once the immediate crisis had passed. But we could have the same thing today, but I think it's less likely because central banks are in there taking opportunity. Any stock that comes out, they will buy. So I think that the physical market, it's unlikely to suffer the sort of problems that we saw in late 2008 and into 2009. Mining stocks could be different, though, because there are some very substantial profits there. And what people do when things start going wrong is rather than sell the things that, and realizing losses, what they do is they hang on to the rubbish that they're making losses on and sell the good stuff, which will be mines, of course. So I think we could be in for a period of enormous volatility. And I think it's important to understand why that volatility is there. And then you can probably navigate your way through it, at least better than if you didn't. Let's put it that way. Yeah, it does make a huge difference because the central banks undoubtedly will be in there buying any physical gold that comes on offer. And I think the answer is there won't be any coming on offer. It'll all be in the paper markets. That's where the volatility will be, if you like. But interestingly, if you look at the open interest in COMEX at the moment, just to take futures market, it's sort of not that high. I mean, it's sort of average to slightly less than average, which suggests that the amount of speculation, the amount of, if you like, momentum trading, speculative trading, and so on and so forth in the futures market is actually not all that great. So, the idea that they could sort of maybe bash it down and really shake the trees, as it were, get out to all the loose holders, that doesn't really apply in this situation. So it is a fundamentally different situation. And of course, the other thing is that I think this is a topic you might like to follow up on. China is definitely making a move to make gold exchangeable for yuan by opening vaults outside China. SGE vaults are being opened in Hong Kong and also in Saudi Arabia, and there will be facilities in other Southeast Asian nations. So the whole of the BRICS cohort, as it were, will be looking at a situation where, for trade purposes anyway, the yuan and gold will be exchangeable, and presumably at some stage in the future there will be a fixed exchange rate. So if you're an African central bank, it does make sense that you've got to start accumulating a bit of gold. If you've got mines in your territory which produce it, you'll hang on to it, which will leave the market short. If, on the other hand, you haven't, then you've got to go into the market and try and get some. So I can see that central bank demand for gold is probably going to accelerate. And the other side of it is that following the debacle earlier this year, when the Bank of England had a rush on its vaulted stocks, I think the central banks who saw their leased gold walking out of the door will think, I don't think we really want to do this in future. So I think you'll find that gold leases, which are essential for the liquidity of the forward market in London, I think the availability of those leases is going to diminish. I suspect it's already diminishing. And I think that the bullion banks are already aware of this, which is why they're quite happy to talk the price of gold up now, just as the major banks are. You get Morgan Stanley and so on now openly talking about higher gold prices and talking about, well, you should have 20% in gold, I think, in the case of Morgan Stanley. Things have changed hugely, but it's just that, when the equity bubble pops, there's going to be a lot of widespread fallout in all sorts of different things which are not directly related. The Bank of China is now extending facilities outside China whereby yuan can be exchanged for gold. That's the whole point about the new SGE vaults, which are being opened outside China. I mean, they are exclusively for the exchange of gold for yuan and vice versa. So that, I think, is a very clear signal that in the future, trade settlement on a national basis, if you like, what it's called international, between nations, will be on a yuan which is tied to gold. And it looks to me as if it's going to be, if you like, a modified version of Bretton Woods, where Chinese nationals or indeed nationals in a BRIC nation can't sort of go along to a bank and say, I want to change these yuan for gold or whatever at the exchange rate. I think it will be just available at the international level between nations. That's the whole thing. It'll be for trade settlement.
Alasdair Macleod argues that the current setup in gold and silver markets is fundamentally different from 2008. Back then, forced liquidation pushed gold from $1,000 to $680 before launching into its historic run. Today, central banks are consistently absorbing every ounce of physical metal that comes to market, making a deep structural sell-off far less likely. The volatility ahead, he explains, will be concentrated in the paper markets, COMEX futures and leveraged positioning, because physical supply is tightening while global demand accelerates. China's expansion of SGE vaults outside its borders underscores a long-term plan to make the yuan and gold directly exchangeable for international trade. This shift, combined with diminishing gold leasing capacity in London, suggests we are entering a new era of price discovery, driven by physical flows rather than speculative momentum. Let's get into the interview.
I mean, that is absolutely clear. If you can't see it, then, you wake up, for goodness sake. It's all there in front of us. But what it does mean is that all the members of BRICS, who on the one hand are terrified of, having their dollar loans called in by the Americans or regime change forced upon them. I mean, this has been the history, if you like, of American imperialism. They're really quite careful in what they're doing, walking a bit of a tightrope on this one. But they can see which way this is going, and it does encourage them, I think, to get trade settlement arrangements in place. Hence signing up for the Chinese exchange trade settlement system. They've rather got to do that, and I think very, very quietly they're doing it, and very quietly they're looking to beef up their gold reserves as well, because they will need them in this new world. I mean, what we're looking at is a post-fiat currency world. It's not just me who's been saying it. It's, I think, some of the smarter heads, if you like, in central banks. They know what's going on. They may not be able to do anything about it, and they also follow policies which they know to be wrong. But these guys aren't stupid. They understand the difference between money and credit. And consequently, they're going to protect themselves against a complete collapse of the fiat currency system, which is what we are moving towards. And you can see how that's going to happen too, because when this equity, or if you like, the financial asset bubble pops, and this is particularly the case in America, then you're going to get collapsing stock markets. You're going to get collateral problems, which I've just described, through all the margin loans being foreclosed on and all the rest of it, which will increase the selling into a falling market. And at the same time, you're going to see businesses faced with higher refinancing costs, banks reluctant to lend anything into the private sector. So, this is going to, if you like, hit the non-financial private sector very, very hard in terms of cash flows and all the rest of it. Consequently, we go into a slump. Now, what does the US government do under those circumstances? Well, the answer is quite simple. It stands there to rescue everything and to stop a slump happening, and indeed, if possible, to stop even the stock market sliding. How do they do that? By debasing the currency. They debase the currency not by suddenly announcing a new rate of exchange to gold. What they do is they just print, and they're already doing this. This is the whole point about the Fed changing tack from worrying about inflation to saying, okay, stop QT, start QE. Interest rates are secondary, but the point is we've got to get liquidity into the system to stop it falling over. That was what the Fed was doing. I mean, it was a very clear signal to all of us where the priorities now lie. I mean, one of the things that's been sort of undermining sentiment in the market a bit is we were absolutely certain that we were going to get another cut in the Fed funds rate in December. Now it's 50-50.
The broader picture now points to a world quietly preparing for a post-Fiat environment. Nations tied to BRICS understand the risks of dollar-based obligations and the historical consequences of crossing Washington. That's why trade settlement arrangements are shifting toward alternatives, and why gold reserves are being strengthened behind the scenes. As the global equity bubble reaches its limit, the chain reaction becomes clear. Forced liquidations, collateral calls, tightening credit, and a deep squeeze on the real economy. When that happens, policymakers will intervene with the only tool they truly control: currency debasement, liquidity injections, halted tightening cycles, and renewed QE will become the default response, reinforcing the reality that fiat stability is already slipping. In that environment, the logic of protecting purchasing power becomes undeniable, and the move towards sound money accelerates. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.